Get that YouTube going. How you guys doing today? It is early. 8:59 on this 5th day of February. That's so hard to say. Good morning, Steve. Good morning, Hamid. Great to see you guys. Oh, gonna be a good day. Every day's a good day, right? We woke up. What a wonderful way to start. Good morning, Miss Adriana. Guys, today is Wednesday, February 5th. Gonna check news like I always do. It's important to me to know when news releases are coming out, not because it matters to me what they're saying. Couldn't care less, to be honest with you. But what I do know is that there may be people with deeper pockets than mine waiting to have some sort of reaction when the news releases. If it's positive, they may do one thing. If it's negative, they may do the other. And I just can't predict it. Their emotional response to news is not a pattern that I can recognize, so I choose to avoid trading during news, both high impact and medium impact. So we already made it through our 8:15. I'm not sure if it did anything. I wasn't watching. That's typically when I go make breakfast, so I don't trade into news. 9:45, we have some medium impact news, final services PMI. At 10 a.m., the ISM services PMI. At 10:30, if you are a crude oil trader, crude oil inventories is trading at 10:30 a.m. There can be a reaction. There's a bunch of FOMC talking heads flapping their gums in the afternoon. No big deal, low impact. So every morning I go in and I check that. Then I drag you guys over to the Nexgen page where I tell you with no uncertainty that if you go into the trading guide, everything that you need to be successful with the software as a brand new user is available to you here. Inside the trading plan are the rules for the highest probability trend trade that we teach. It breaks down the individual rules. It shows you how to recognize them. It even shows you how to enter that market. That's exactly what I'm going to do. Good morning, Bob B. I'm going to talk about a high probability trend trade today. That's going to be our focus. And the high probability trend trade is a trade when each indicator on every chart agrees with the rules for the trade. Triggers will be their strongest. There'll be no termination conditions, nothing between you and your targets. And this really is the best of the best trade, guys. This is what we call a foundation trade. This is laying the groundwork, allowing you to see the other opportunities in the market, because it's going to teach you how to read your indicators. And that's really the goal for, I would say, your first 30 days with Nexgen. We all want to be millionaires in the first 30 days, but let's be realistic, right? Nobody walked into their freshman year of college said, man, I'm making 6 figures next week with this education I'm going to get over the next couple years. Nobody says that. But for whatever reason, day traders have this unrealistic expectation that they're going to waltz in and be perfect from day one. It just rarely, life doesn't happen like that. So there's an easy way to get to where you want to be, and it starts with learning to read your charts through this high probability trend trade. If you scroll up to the top of the chat box for the day, I gave you a zip file called All You Need, and I gave you the Nexgen tracking sheet. Both of those, I thought I'd expedite the process instead of going back and forth. If you haven't downloaded those yet, download those, please. That literally is everything that you need to be successful. Everything that I use in the presentation over the next hour, hour and a half, however long it takes, is inside of those zip files. Is made available to you, and I'm going to teach you how to use it. So we're going to talk about the high probability trend trade. 3 trading rules. How great is that? That's all. That's got to be easy to remember. Hey, good morning, Harry. Good to have you. And let's just learn how to read our indicators. Don't overcomplicate it. Don't add your spin on it. Just let it be what it is. And we're gonna go after it the easiest way I know how. And we talk about chart reading because chart reading is 90% of your day. You'll hear that about 100 times today. Chart reading is about 90% of your day, 90% of the overall process. And actual trading makes up the remaining 10%. 6-hour day, in front of your computer, you're likely to be active about 36 minutes, probably less. Good morning, Cap. Great to have you, man. But achieving mastery in chart reading encompasses three vital elements. I hate AI. When you can read your indicators, you'll understand where the market is likely to continue. These likely to continue, what does that mean? That means that you're going to be able to pinpoint precisely where the existing trend is most likely to continue. And this becomes your entry for the highest probability trend trade. You will understand where the market is likely to go. Good morning, Miss Jen. Understanding where the market is likely to go is really going to work its way into your management plan. It's going to be very effective in helping you decide on where to put your targets. And then you're going to understand where the market is likely to stop. These likely to stop areas are what we call termination conditions. These are areas that you know about long before the market reaches there, and you will have a very basic two-part plan to make sure that you're not trading into those likely to stop areas, those areas that could stop the trend that's been going on forever. So we're going to take a look at learning how to read our indicators, and we're going to do it with three simple rules. You screwed that up this morning? Oh, you can't screw up. You can only learn, right? The stop, the D-top. What's the D-top? Is that the stop? Stop placement? Give me a heads up on which direction I need to make that lesson go. All right, stop placement. So I'll keep that in mind when we look at your charts, Jen. The high probability trend trade. Let me throw a disclaimer out there real quick. This is not the only trade. This is not even the only trade that Nexgen teaches. This is not the only opportunity in the market. This is not the only way to make money with the software. This is laying the groundwork, teaching you to read your indicators. The way I teach in the very first hour of classroom is the best of the best, highest chance of success to take this trade. As you grow with the software, your plan will deviate. I want you to know that. But when I talk about this in the morning, we're talking about the best of the best. And the best of the best means that all three rules are met. That is your criteria for entering a trade as a brand new user. Each rule in white provides an advantage when it's true. So rule number one, strong triggers will give you the advantage of momentum. Most of us know what that means. Momentum is the advantage that pushes the market in the direction of the trend. Momentum is the advantage that helps us break key Fibonacci areas. Momentum is the advantage that even covers up a lot of the mistakes that new users tend to make. So rule number one, the advantage of momentum. We're going to do this like a flow chart. If I have the advantage of momentum, well then I'll make sure that there's no termination conditions, none of those likely to stop the market areas. If rule number two is true, there are no termination conditions, well then I have a clear path. So once I have momentum and a clear path, I'll look for an entry. That's rule number three. Rule number three is pinpointing where the market is most likely to continue. So a trade is the accumulation of three advantages. And allowing the advantages to be true in this order. Awesome, Ron. Have momentum before you look for the clear path. Make sure that market's pushing. Once you have momentum, add that clear path. These two advantages on their own are enough to build a trading plan, and you will see people in this room with a trading plan based on these two advantages. And it's pretty outstanding watching you guys capitalizing and getting paid with it. Rule number three is specific to the high probability trend trade, but what rule number three is going to do for you is it's going to give you the best of the best entry. It's going to give you the least amount of risk. It's going to give you the highest profit potential. And this recipe for a trade is momentum, clear path, and entry area. That recipe is prepared on only two charts. That's it. I try to simplify everything as much as I possibly can. We're going to let the large chart lead the way. This is the chart that's going to be on the left side of your workspace. This is a 13-2 chart for the crude oil market, for the S&P. And the large chart is going to define the direction, letting you know which way you should be looking for trades. The large chart will define the momentum through rule number one, making sure that that advantage is in place. And the large chart will define the areas that could stop the market. Rule number two is going to use those areas to keep you from trading into areas that may stop the market. All of this happens on the very first bar. One bar on the large chart. On this slower moving chart, there is 26 ticks of data. A tick is the smallest increment the market can move in. So there's a fluctuation inside of here in a 26 tick range, defining momentum, direction, and areas. Well, rule number 3 happens on a small chart. And on a small chart, there's only 12 ticks of data in a bar, which means that you're going to see the inner workings of that one bar that's giving you those advantages. You're going to see ups and downs and pushes and down bars and up bars. And we're literally just refining that one bar, taking that x-ray and pinpointing the best of the best entry. By using this refinement process, what happens is you are able to reduce risk dramatically. You're able to increase your profit potential, and that's where rule number 3 is going to come in. It's just an x-ray. Bottom question. So when we get to rule number 1, we'll talk about it. I don't consider that strong triggers because there's a termination. So Wayne, let me just clarify. Are you thinking, okay, strong trending market, smalls are riding the large? Yeah. You still want a clear path with that look? Until the triggers break, it's your rule number 2 is not in play. So we're not defaulting to that strong trigger. Once you break this area though, absolutely, you're reading it beautifully. As long as there's 30 bars without a reversal bar in there. Awesome. And guys, there's a little insight to how this room works. If you have a question, ask it. I'll get you an answer, I promise. So 2 charts, big chart, little chart. Broad stroke of a brush, refinement chart. We use these 2 because it's important to think about who you're trading with or who you're attempting to trade against. The big charts define the areas, the directions. They're really just the opinion of the market, the overall, the big crowd. The big crowd with the money, with the influence, with the ability. And simply trading with the big crowd typically produces results. The small chart is the small crowd. These are the men and women with more money than us, and they create little pushes, little fights, if you will. That's what this is. This is called a retracement or a pullback. And the small crowd has it in their hearts. They want that market to go down, even though the big crowd wants it to go up. And they've got enough influence to create that retracement, but they typically fail 70 to 80% of the time in their push, which means that when we use rule number 3, we are actually pinpointing right where that small crowd is most likely to fail. We're using that for our entry, that likely to continue point, and that's what allows us to reduce our risk and increase that profit potential. So we're going to follow the lead of the big chart, but we're going to hope that the small crowd fights, and that's our entry chart. So over the next hour or so, we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. When I say for when it's okay to trade, I want you, until you reach that next level, have 2 options when it's time to enter the market. Either the rules are met and you enter the market, or the rules aren't met and you choose to do nothing. Remember, 90% of your day is doing nothing. You all have the ability to simulate. You have a working copy of the software, 100%, absolutely nothing missing. You have NinjaTrader to run it on. You have live data. And you can simulate and practice these trades over and over and over again. And then the first step to getting to where you want to be as soon as possible is posting those pictures in the room. Wayne just gave us a great example. Wayne didn't even take a trade. Wayne just had a question about a chart read, and he said, "Hey Mark, little clarification please." And he got it instantly. This class is designed to be a discussion. You start the discussion through posting in the room, telling me what you see, showing me your trades, asking me your questions. And every time you post in my room, it's a private session. You and I will have a one-on-one. We'll forget about the other people in the room and we'll get you the answers that you need. Other people in the room, I would eavesdrop. There's typically a lot of great lessons in the pictures that are posted. My hope for you is that you'll keep posting pictures until you're sure you have the correct rules, until you're sure that you understand and are reading the charts accurately. Practicing the wrong trades, trying to build simulator wealth. It's fun, right? It's fun to drop 100 lot at a red line, fight the trend, get lucky. But when you do that, you're creating this short-term victory, that little dopamine kick that we all crave. But you're setting yourself up for long-term failure because the market has a memory and the market creates patterns. And when you post in the room, I'm going to let you know if you got lucky. I'm going to let you know if you fought everything and kind of pulled one over on the man. And we will always resort back to what's going to provide longevity. We will simplify this morning, not only in our approach to learning the indicators, but also in the trading plan that I provide you. It was in that zip file, everything you need. Initially, we're only going to talk about one trade. The one trade opens the doors for all the other trades. And to be honest with you, the lessons that you take out of the high probability trend trade, understanding momentum, understanding termination conditions, pinpointing entries, those very basic rules, those foundational rules are going to carry into all the other rules of the other trades, and you'll be using those lessons. You need to figure out what looks you'll commit to. I'm going to give you the looks to this morning for the highest probability trend trade. As you grow and develop your plan, you're going to begin to see more, but we're learning pattern recognition. The market has a memory, it repeats itself, and there are patterns that have been proven to win more than they lose. That's the high probability trend trade. You've got to learn the looks so they become easy, and that's the second piece of becoming a trader confident ASAP. Using this trade tracking sheet, again, it's already been dropped in the room. I can drop it in there again. It's fine with me. But there's 4 tabs on this trade tracking sheet. The first tab is a trade journal. If you were brand new, never looked at the market before in your life, and you went to the CME website, the Chicago Mercantile Exchange, and you typed into their search bar, what do I need to start trading? They would tell you, have a trade journal. Track your progress. That's exactly what we've provided here. It allows you to define the type of trade you're taking, because the type of trade you're taking will let you know which rules you should be following. It'll let you know how you should manage that particular trade. So be able to define your trade as you get into it. It gives you a section for pictures. This is where you're going to take those pictures, the same pictures you present in the room, the same pictures you put annotations on, you're going to drop them in here. I really want you to focus in the beginning on momentum and clear path, because these are the rock solid foundation that you're going to grow from. And then the final section in this trade journal is feedback from class. Every time you post in the room, we'll go back to the 3 rules. We'll look at your chart read, and we'll make sure that you're reading correctly. And that's where, and there's a link in there, to get the best feedback in class, to really get the fastest forward progress with the software and your chart reading. Every time you post in the room, describe rule number 1, strong triggers. Let me know, point it out, and tell me what your chart read is. The same thing with the path. Show me your entries and your exits. And what happens is every time you post in the room, we're going to look at the patterns, look at the reads. If there's anything that needs a little bit of help, something to help you be a little more accurate, a little more efficient, I'll give it to you. If there was a way to enter that trade with less risk, we'll talk about it. If there's a way to hold on longer and get more out of it, we'll talk about it. Every time you post in my room, we're going to try and make you just 1% better. So how to annotate for feedback is here in the picture section. Also pasting into the spreadsheets in this section too. But what you'll notice is you'll begin to see in this feedback things that repeat themselves. You'll be able to see that trading in determination conditions is killing me, or you'll see that this is exactly what it should look like. You're building your plan. You're beginning to see what to focus on and what to avoid. And even more so every morning. And this takes 2 to 3 minutes. I know it feels like I'm giving you tasks, but This takes 2 to 3 minutes. Go back and look at what you did yesterday. What brought you success? What felt easy? What didn't? What worked? What didn't? And you're really going to prepare yourself for the day because you're going to set your mind in motion, looking for the advantages, looking for the reasons that you're doing well, repeating the patterns that are bringing you success, and then you'll have the ability to see the pattern that's pulling it from you. And that's one of the things that I get pretty good at is I'll see the patterns in you. Give me 4 pictures of annotated charts. I'll understand what your strengths are, what your weaknesses are, and together we'll work to get you where you want to be. The second, guys, can everybody hear me? Can you give me a Y if you can hear me, please? There we go. If you ever can't hear me, all you have to do is go, hey, sound check, can't hear. And then when you see 5, 6, 7 people post a Y, it means that it's on your end. Reboot. And Gary knows that. The second tab. This is where you're going to become a chart reader the fastest and most efficiently. These are the rules for the high probability trend trade, exactly what they look like when they're met in the green section. Each picture is a picture of the individual rule, not a trade, and it's describing exactly what it means, why the rule is met and what it means to you. And then it also shows you what it looks like to not have your rules met, so you know what the market's going to look like when it's time to sit on your hands and do nothing. Nexgen users have been nice enough to post in my room for the last 5 years. I've stolen a lot of pictures of perfect trend trades. I've stolen a lot of pictures of you guys doing outstanding things with these advantages. Almost 400. Please go through, take a look at them, use them as a study guide. If you have questions about any of the pictures you look at in the spreadsheet, take a picture, bring it to the room. Mark, I know you say area inside of triggers, but this one wasn't. Explain, please, and I will. But remember that these are clients' trades. These aren't Nexgen study guides. These are clients, so they may differ a little bit, but they're still using the advantages. That's how they got in here. There's the high probability trend trade sequence, both long and short. A very, very mechanical beginner's way to manage it. And then there's pictures of how your management plan can grow as you grow. And there's pictures of patterns that repeat themselves in the market over and over. These are outside of the rules, but these are patterns that will work their way into your day trading day as you grow and you grow your plan. You'll see more and more. Remember, right now, all we're doing is we're talking about the absolute best of the best way to do things. So by the end of this first hour, we'll say starting now, you will have everything that you need to be successful with the software. The only thing that Nexgen can't provide you is the repetition that it takes to feel comfortable, the repetition that it takes for these reads to become quick. So the more pictures you take, the more you participate in class, the more you go back and study your spreadsheet, the more likely you are to reach the goals that you told us you wanted to reach. So let's get going and let's just talk about what's on the charts. What are we looking at? You want to understand the language in the room, so this is the language. On every chart, there are small and large triggers. Small triggers are 2 solid lines working together. They're a fast-moving average. Large triggers are 2 lines working together. They're dashed. They're a slow-moving average. That is about as in-depth as you need to get on triggers. You just need to know which is the small and which is the large. We're going to use these in everything. We're going to use these to define momentum. We're going to use these to define termination conditions. We're going to use these to pinpoint entries. So know the difference between the small and large. How easy is that? And then every chart's going to have areas. We're just going to name them here. We're not going to talk about how we're going to use them. There's divergence highs and divergence lows. These magenta and cyan lines will print right off the end of a pivot if momentum does not follow price. So every time you see a divergence line, I want your brain to scream, oh my gosh, there was a loss of momentum. That's it. Associate divergence with a loss of momentum. You're going to see Fibonacci resistance on your charts. You're going to see Fibonacci support, red and blue lines. You will see these yellow 1-to-1s. You will see a midband. Midband will be green. If price is above it, it'll be magenta. If price is below it, Crude oil S&P traders, you're going to see these pink little one-to-ones, these pink dots. I want you to learn how to ignore them. They are insignificant on a crude oil or an S&P chart, but because there's a lot of work that goes into creating an awful lot of workspaces, it's easier for John Novak to just put them into every chart. So I want you to learn how to tune those out, and if you want to learn how to get them off the chart, let me know. We'll do a little tutorial. These areas and these trigger lines will come into pretty much everything you do throughout the day, but we're going to start on the large chart. We're going to let the large chart define the trend. We're going to let the large chart let us know if we have strong trigger lines. So rule number one, strong trigger lines. In order to have strong trigger lines, you need to be trading with the trend. So let's define the trend. If the background is green on your large chart, the market's in an uptrend, you should be looking for rules to be met for high probability trend trades long. If the background is red, you're in a downtrend, you should be looking for rules to be met for high probability trend trade short. Just because the background is green doesn't mean you have a trade. It just lets you know the direction you're looking for your rules to be met so that you can have a trade. So, what are strong triggers? In an uptrend, both the small triggers and the large triggers must be green. Here's a little make it simple tip for you. If the background and the trigger lines are not all the same color, you don't have strong triggers. If the small triggers and the large triggers are not the same color as each other, you don't have strong triggers. So the colors need to match. Both background and triggers have to be green. Strong triggers means that the small triggers in an uptrend are above and have broken away from the large triggers. The large triggers are wide. There is no momentum in a flat trigger. You want the triggers wide in the direction of the trend. That space created between the small and the large lets me know that the odds are favorable for the market to continue up. And in a downtrend, it's the same look, other direction. Small triggers will be below the large triggers. Large triggers will be wide, angled in the direction of the trend. And once again, it's the space between the two that lets me know that the odds are favorable for the market to continue down. So the language that we're going to use in the classroom, and you're going to see this annotated on charts as OFM, odds favorable momentum. That's what the strong trigger provides. These strong triggers, this odds favorable momentum, they push the market in the direction of the trend. This is the look that it takes to feel like there is the potential for Fibonacci areas to break as you work your way into the second trade that we teach. Strong triggers can cover mistakes that new users tend to make because it's hard to stop a large chart screaming in the direction of a trend. And when you have these strong triggers, you're actually going to look for opportunities to buy or sell Fibonacci support and resistance. They look like tails on a large chart or wicks when price breaks below the halfway point. You will be able to pinpoint where this tail is most likely to form using that smaller, faster chart. But momentum is always momentum, no matter what chart it is. Smalls separate from the large. When the small triggers work their way back inside of the large triggers, we call this a weakening of the large triggers. I'm a big fan of language. When I have weak triggers, I have to say to myself, anything can happen up or down. You'll see it annotated on charts, ACH, anything can happen. And if you let that resonate, why would I want to risk my money when anything can happen, right? That's not an advantage. That's rolling the dice. That's hoping. That's Vegas. So odds favorable momentum is rule number one. So from the point of separation until they return, this is where we're going to look for our opportunities. This is where we're going to look for those pullbacks on a smaller, faster chart, those fights. So between these two areas, any point on the large chart bar that is lower than the midpoint, you'll see that Taylor wick. You're going to learn how to circle these to go back and to say to yourself, these are all potential long entries. And you'll be able to use that smaller, faster chart to look at the pattern to see what you get. One second. Gary's having troubles. And the same is true in a downtrend. Separation means strength. Separation means strength. When I have that strength, when there's nothing in the way, these tails represent potential entries. So as we go back to the other rules, oops, you know what? I didn't open NinjaTrader. Give me a why in the room if you don't mind. Let me know that you're comfortable with the idea that separation of the triggers means strength, that strong triggers lead the way, that strong triggers provide momentum, that strong triggers are everything that you're looking for in order to look for that second rule. And there's no reason, it's a flow chart, there's no reason to look for a clear path if you don't have strong triggers. I'm opening up my NinjaTrader right now, so I'm trying to multitask. And it's loading right now. And let me tell Gary, thank you, Josh. Guys, I'm not very good with Discord beyond teaching the room. I wish I was, but I'm not. I want to be, but I'm not. So very often I will steer you towards tech if I don't know how to fix your problem, and this is one of those ones that I don't know how to fix. I've never had to listen to a room in Discord in my life, so I only know how to use the microphone. So rule number one has me with the advantage of momentum. Rule number one, I love rule number one. It's hard to stop a large chart with odds favorable momentum. But momentum isn't enough. And momentum acts alone. Momentum has nothing to do with areas. Momentum has nothing to do with price bars. All momentum is two trigger lines broken away from one another. Once I have it, I'm going to make sure that I have a clear path. No termination conditions. And no termination conditions is making sure that all that momentum doesn't have a brick wall to run into. So a termination condition is a Fibonacci-based indicator that may reverse the market. That's it. Those areas that we looked at earlier, those horizontal lines on a large chart, each of these areas could stop the market. Each of these areas are where the large crowd is likely to make decisions, where buyers and sellers might enter or exit, where they may fight one another. These key areas are where reversals can happen, and you'll know about them long before you get to them. And you're going to use those areas and the trigger lines and just create a little comparison to understand whether or not you should be taking that next trade. So if the large crowd is making decisions at key areas, it kind of sets up for the recipe for defining a termination condition. Everything begins with price reaches the area. So dynamic Renko bars had been trading up, everything's cranking, and they reach Fibonacci resistance. They reach a yellow 1-to-1. They reach a divergence high. When price reaches resistance, the only thing you have to do is ask yourself, where are my triggers? And this is what I do before every trade that I take. Did price reach an area? Where are my triggers? So if price reached an area and my triggers remain below resistance, no long trades into that area. You've just defined a termination condition. You've just defined an area that may stop the market, that may produce a fight between the buyers and sellers, that could create an untradeable bounce, or that could break. And the reality is, you'll never know what the reaction is going to be. There is no crystal ball that you can look into. There's no 1-800 hotline to get the inside scoop. So when price reaches an area and the triggers remain below resistance, or price reaches support and the triggers remain above support, rule number 2 isn't met. We don't have a clear path, absolutely no trades into that area. And I know it sounds, that's just too easy. Mark, how could that possibly be that easy? I watch the bars hit a line. If the triggers don't break, I do nothing. That's it. That's the keys to the kingdom, guys, because Rule number 2 isn't based on the one time that areas break. Rule number 2 is based on the 10 times that it doesn't, the 10 times that you lose money trading into those lines. Not the one time where you get lucky and it breaks. This was a day in crude oil. This was an 11-hour period, 36 times. The rules for a termination condition kept you out of the losing trade. 6 times that the areas actually broke and produced a winning trade. 90% of your day is doing nothing, respecting these areas. So price reaches an area, no triggers, no trade. Price reaches an area, no triggers, no trade. If this termination condition, if none of the triggers get through and your large triggers go from green to red, that's a reversal. That's the market telling you it's going the other direction. If a termination condition reverses the market, you have what we call a strong top. And if a termination condition at a low reverses the market, you have what we call a strong bottom. The key is that no triggers get through. If a trigger gets through, it can't be a strong top or bottom. Both lines of the small, both lines of the large. A strong top or bottom is the precursor to the highest probability trend trade you could take. A strong top or bottom typically results in a longer reaction the other direction. A strong top or bottom is rule number 1 for most of the trades beyond the high probability trend trade. So while you don't have to have it for the high probability trend trade, it definitely adds a level of warm fuzzies as you look for that trade. Everybody good with that? Price reaches an area, no triggers break. Let's sit on our hands. I've got the S&P loading up. I'm going to see if I can get my live market up here pretty soon. Struggling a little bit. But areas do break. So I want to show you what it looks like when an area breaks. The first one here has the stop sign on it. Says, hey, if price reaches resistance and the triggers are still below, this is a termination condition. Wait to see what the reaction is. So that's where your highest chance of success comes in, by doing absolutely nothing. This also happens to be where the market was likely to go with all that momentum. What a great place to take profits if you haven't already. An area is considered broken. We're going to jump to number 3. When the small triggers and the large triggers get above resistance, resistance behaves as support. Your path is clear. Rule number 2 is met until you reach the next area. I went to 3 because once you understand the difference between 1 and 3, it sets you up for the second trade. It sets you up for what we call a 50-50 trade. And a 50-50 trade means that your smalls have smashed through the area. And with all of that momentum, with the large triggers below and the small triggers above, momentum lets you know, hey, this area has the potential to break. But it's not broken, so rule number 2 isn't met. So you have to manage it a bit more assertively. So it's absolutely no trades. Potential to trade, trade away until you hit the next area. And the same is true going down. Absolutely no trades, wait for the reaction. The potential is there, you can take them, but you have to manage assertively. But once that path is clear, support behaves as resistance, resistance is support, the path remains clear until you reach that next area. So let's go to a large chart here and see if we can find some examples of the rules that we've talked about so far. Look at this market. Sometimes with odds favorable momentum, it's going to go up anyway. Yellow 1-to-1s, the triggers don't break. The market pushes up all the way to the midband, and Fibonacci printed at the update, triggers remain below, and it pushes down, and it comes back and retests resistance, and it goes to support with the potential, but it hadn't broken yet, and you'll notice that now the market is going up. If we back up a little bit, yellow 1-to-1s and the triggers don't break, that's where the downtrend started. Fibonacci support, absolutely no triggers through. Look at the reaction. Those yellow 1-to-1s had the potential to break, but they never did, and sure enough, it comes all the way down and retests support. They tried to go lower, but the buyers said, no thank you. What a great spot to start the uptrend. Straight from resistance, support, resistance. If you go back and do a little bit of study, if you start looking at strong triggers, if you start looking at areas holding, you're going to develop an enormous amount of trust in Fibonacci. You're going to develop an enormous amount of trust in momentum. But you have to remember, there's going to be times when your path isn't clear, when rule number 2 is not met because the areas are stacked a bit. You see it a lot, especially if the previous day had an awful lot of movement. You'll see some extra fibs in there. This is 90% of your day, and you can see it in this picture. Support had the potential for just a second, and then dang it hit another line. And it had the potential for just a second, and then dang it hit another line. This is 90% of your day, and I want you to know it's okay to do nothing. It's all right to sit on your hands. The futures markets trade billions every day. It's insane how much money is exchanged in these markets. It only takes you $200 per contract on a 2-lot to put yourself in 6 figures. So the idea isn't that we have to be the first one in because there's a line, and we have to be the last one out hoping that these lines break. Guys, you're about to find a way to capitalize in between these key areas with all that momentum to capture your profits and be out of the market before the trouble ever happens. So, you guys with me so far? Large chart leads the way. The large chart will define the direction, the momentum, and the areas. Rules 1 and 2 have to be met in order to go to the small chart. The small chart is an entry chart. It's a refinement chart. It's a faster chart. It'll even show the change that you can't see on the large chart. So there's one time before we get off of termination conditions that I want to show you where the small chart will tell you under no circumstances should you take this next trend trade because now there's a termination condition present. And that is 3 divergences in the same price range. 3 divergences from a low, cyan lines from a low. This may happen in maybe 1 or 2 bars on a large chart. But on a small chart, you're going to see 3 losses of momentum in the same range. This can terminate a trend. It becomes more powerful with weak triggers, the same lesson from rule number 1. And it becomes more powerful still if that third pivot is higher than the previous from a low or lower than the previous from a high, creates a head and shoulders pattern. So not only does the market lose momentum 3 times, it loses momentum again with weak triggers. And then price can't even push to the previous pivot, and it loses momentum. No short trades. Guys, that is the only time I'll let the small chart talk me out of a trade. But if I don't have it, I'm going to use a limit order to buy or sell that pullback created by the small crowd at an area inside of triggers. That's that 1 breath entry rule. Use a limit order to buy or sell a pullback at an area inside of triggers. And there's some key concepts here. The first one is areas. Areas produce bounces. But triggers will define where that retracement is most likely to occur. Triggers will define where the pullback is most likely to go. So on your entry chart, there are 2 sets of large triggers. There's the large triggers that are native to the 5-1. They're smooth. The separation between those and the small triggers defines momentum on a small chart. But there's also the 13-2 large triggers. These are called synthetic triggers on your small chart. You'll see that they have kind of steps. They're not quite as smooth. These 2 triggers work together to define where the retracement is most likely to occur. So from the top of the trigger lines to the bottom of the trigger lines, this is where the retracement is most likely to happen. The tighter they are, one on top of the other, the smaller that retracement range is. The tighter they are, one on top of the other, the least amount of room there is to put areas inside. The areas are where the bounce happens. It's this look, favorable large triggers, that will help reduce risk, that'll create the absolute smallest range where the market is likely to continue. You will see this look. It makes it a little harder to be accurate. So for brand new users, once again, I'm teaching the best of the best in this first hour. Favorable large triggers are your best look for a trend trade. So let's go through and let's define. How do I get into the market? Where do I put my order? What am I looking for? Well, you're looking for rules to be met on the large chart first. You're looking for odds favorable momentum. You're looking for a clear path. When you have it, when you have both, it's time to go to the smaller, faster chart, and it's time to look for your entry. Your small chart, if the market is going up on the large chart, should be going up as well. The background is probably going to be green. The triggers should be strong. And you're going to wait for the small crowd to fight. That's a reversal bar. So when everything is going up, you're going to squash your desire to just jump into the market, and you're going to wait for the small crowd to fight. You're going to wait for a reversal bar, a down bar after all of those up bars. And that down bar says, hey, guess what? Here comes the retracement, here comes the pullback. So once I get the reversal bar, I have to define where that retracement is most likely to go. And it's most likely to go somewhere from the top of the triggers all the way to the bottom of the triggers. So this white box is defining where the retracement is most likely to happen. And the tighter those triggers are, one on top of the other, the smaller that box will become. But we can make it even smaller by defining where it's most likely to bounce. And it's most likely to bounce in an area. Fibs, midbands, or yellow 1-to-1s inside of triggers. And that language inside of triggers is very important. These yellow 1-to-1s are before the retracement zone. That's not my entry. If there was a fib down here, it's on the other side of my retracement zone. That's not my entry. So we're going to take that big white box where the triggers are and make it a small white box, the areas inside. This is where the market is most likely to bounce and continue with the trend. This is where the small crowd is most likely to fail. Everybody with me so far? This 2-tick wide box defines where your entry needs to happen. Because of the momentum, because of the clear path on the large chart, your job is to right-click and activate a limit order 2 ticks above the highest point of support. And this becomes your entry for the highest probability trend trade. Activation of a limit order doesn't guarantee an entry. Getting an entry doesn't guarantee a win. But what you've done is you've identified a pattern that has been proven to win more than it loses. You have determined exactly where the market is most likely to continue, and you're waiting for the small crowd to put their dukes up, fight the large crowd, and hopefully come fill your order. If price reaches your order, you're in a long position. You're going up with the trend, you're going up with the momentum, you're going up with the clear path, and you're going up from the area where the market was most likely to continue. Guys, this is your entry. This is the best of the best, the high probability trend trade entry. That's the precision that this particular methodology gives you. So you've got to learn the language a little bit. Large chart leads the way. Large chart's in an uptrend, large chart has momentum, large chart has a clear path. Insist on it. You'll never be in control of anything other than your rules being met. If that's the case, the reversal bar on your small chart, the 5-1 chart, begins the pullback. The reversal bar is not your entry. Define where that retracement, that pullback is most likely to happen. Those are your trigger lines, large and synthetic. The tighter they are, the smaller that box will be. And then create a window of opportunity. A window that extends from the highest point of support inside of triggers, all caps, to the lowest point of support inside of triggers. This blue shaded box shows you precisely where the small crowd is most likely to fail, where the market is most likely to bounce in the direction of the trend. Your job is to activate a limit order 2 ticks above that window. Anything on the wrong side of the triggers, anything below the triggers in a long trade is where your advantage is no longer in place. This is where the market shouldn't go. This is not a part of the entry. This is where the advantage that rule number 3 gives you is no longer in play. This will actually be where you put your protective stops. So the other direction. Large chart's in a downtrend. Large chart has momentum through strong triggers. The large chart has a clear path because there's no termination conditions. You're going to wait for the reversal bar. Seems crazy. I want the market to go up when I want to sell? Absolutely you do, because we want to reduce risk. And remember, all of this happens in one bar on the large chart. So the reversal bar begins the pullback. Gary, did you get with tech? Don't get pissy. Did you get with tech? Guys, if you have a challenge, go to tech. I'm going to tell everybody in this room right now, that would be the third time I've offered tech as help. If you don't go to tech, what you're telling me is you have a headache, but you refuse to take aspirin. There's nothing I can do from where I'm sitting. I apologize. It breaks my heart. Get with tech. Reversal bar begins the pullback. Trigger lines define where the pullback is most likely to go. Areas inside of the triggers define where it's most likely to bounce. This is always the same. Your accuracy is so insane. You're going to sell that market as it comes up on a smaller, faster chart. And anything beyond those triggers is not a part of the equation. Anything above the trigger lines is where the market should not go. Which means by taking a week to learn these rules, by taking 5 or 6 days to identify these advantages, by taking just a little bit of time to pinpoint where the market is most likely to continue, you have also defined where the market should not go. You're going to use the should not go place for your initial stop. Your initial stop will be 4 to 5 ticks beyond those trigger lines. And if the small crowd can push through those triggers, if the small crowd can push beyond those areas inside of triggers, guys, they're going to hit your stop. And anything that wins 70 to 80% of the time is mathematically obligated to lose 20 to 30% of the time. It's a cost of doing business. It really is. So every time you take a loser, every time you have that cost, ask yourself, did I have momentum? Was there a clear path? Did I enter where the market was most likely to continue? And if you answer yes to those, you're going to learn to be okay with this. You're going to learn to be all right, and you're going to say things like, small crowd, you got work to do if you want my money. I'm not just going to offer it to you. More often than not, you're going to get a reversal bar off that area. Reversal bar doesn't guarantee a winner, but it redefines where the market should not go. You can move your stop 2 ticks above that reversal bar, 2 ticks below that reversal bar. And now you've got even less risk in a trade that typically wins 70 to 80% of the time. And guys, this is all we've talked about all morning. Was first being able to identify the trend. What color is the background? The background is green, the trend is up. Let's look for rules to be met for high probability trend trades long. Do I have the advantage of momentum? Are my small triggers above the large triggers? Are my large triggers wide? Is there space between? The odds are favorable for the market to continue up. Guys, this momentum has absolutely nothing to do with this pink line, with that blue line, has nothing to do with price bars or a mid-band or even one-to-ones. Momentum is nothing more than 2 triggers and 1 look. So don't confuse it. But once you have momentum, do I have a clear path? I always start with, did price reach the next area? The answer is no. It didn't. It didn't reach it here or here or here. This just happens to be the bar that gave the pullback. So price did not reach an area. But once I say that, if the answer is no, I say, are my trigger lines above the previous area? Did the small triggers and the large triggers get above Fibonacci resistance? Well, I've got 1 large trigger line hanging below, so I have to say this is not a clear path yet. It's close, but not quite. I'm going to wait for the reversal bar. The reversal bar signals the beginning of the pullback. This reversal bar is the top of this bar, that 1 bar. And at the time of the reversal bar, I'm going to say to myself, you're going to say to yourself, man, I'm so close to that divergence high. I'm only $80 worth of profit away from it. That seems ridiculous. Why would I take a trade for $80? I've done it. And you're going to say, oh no, it's coming off of one-to-ones. That's a termination condition. But you have to remember that termination conditions are defined on the large chart. And you're going to say, oh no, my small triggers are red and my large are green. I can't take this trade. But you have to remember that momentum is defined on a large chart. All we're doing is taking the inner workings of this bar and pinpointing where the small crowd is most likely to fail. And if you enter at the areas inside of favorable large triggers, that $80 potential up to that divergence high turns into a little over 300. If you enter at the top of the move, you have a huge amount of risk. If you get faked out and enter on a little fluctuation up instead of the area inside of triggers, you have a huge amount of risk. And even more so, you've got less room to get to your target. So what you're doing is you're developing a little trust in the methodology. You're developing a little trust in the pattern. That when the large chart says look for an entry, you're going to develop the patience to wait for the areas inside of favorable large triggers, because that's the look that reduces your risk. That's the look that increases your profit potential. So let's go see if we can find one of those tails with the rules met. There's a beautiful example right there. So guys, let's start on the large chart. Does it have momentum? And this is not a perfect entry. Absolutely, the momentum is present. I didn't reach an area, and I cleared the previous, and the only thing left to do, whoops, my apologies. The only thing left to do, oh my gosh, I just crashed my NinjaTrader again. I'm struggling on NinjaTrader today. Is to find that entry. Is to say to myself, hey, did I have an area inside of favorable large triggers? If I did, let me take that entry. Sorry, I'm going to do a little clean out real quick, and I'm going to reopen NinjaTrader, and I'm actually going to delete my S&P because I believe that I've got a glitch. I am tech, as much as I can be. Guys, if the same workspace continually crashes, you probably have something going wrong inside of that workspace. So I'm going to delete my S&P workspace because that's the third time this morning I've crashed it. And I'm going to build a new one. So you guys may learn how to build a workspace today. But that's going to be your study tool. Your study tool is going to be going back, looking for those tails, circling those tails. Here comes crude oil coming up. And just seeing, did they line up? Did they line up with areas inside of favorable large triggers? If you start going through those pictures in the spreadsheet, you'll notice that the top of the tail lines up with resistance inside of favorable large triggers. You'll notice that one divergence doesn't affect it. You'll notice that the small triggers turning against it doesn't affect it. And you'll notice that you're not entering at the bottom of the pullback, but rather taking profits at Fibonacci down at the bottom. You've got to go through and you've got to learn these looks, and you've got to learn to trust these looks. And that's what the next stuff I give you is going to be. But before I do it, are there any questions? Any questions about momentum? Any questions about path? It takes a little bit. Whoops, you got to learn it. This is the easiest way to learn it. This is the easiest way to learn it. Watch this. I don't want Gary to miss out on feedback, but he won't answer me about tech. In order to get to where you want to be, you've got to be able to recognize some looks and patterns quickly, guys. You've got to be able to look at your chart and say, I have momentum, my path is clear, let me define an entry. So the easiest way to do that isn't always taking trades, but rather taking pictures of what it means to have your rules met. Take pictures, 25 pictures of strong triggers, weak triggers, clear path, terminations. Take pictures of those entries. But don't just snap the picture. Annotate your charts. Write on your charts every time. Why is it strong triggers? What is the formula for identifying strong triggers? What's the advantage of strong triggers? Because strong triggers is always strong triggers. Smalls have separated from the large, space between. Rule 1 of 3 is met. So go through that process for each and every rule. Why is it a termination condition? Because price reached an area and my triggers have remained below resistance, above support. And if you do that for each individual picture, if you take the time to snap the picture and to write why the rule is met or not met, what happens is it creates a connection between what you see and what it means to you. So you'll get to the point where every time you see strong triggers, you're going to get excited looking for termination conditions. And every time you see weak triggers, you're going to begin to say, oh crap, anything can happen. I should probably do nothing because my advantage is gone. So you'll ultimately piece those together to create a trade. As you go back and you take these pictures, I'm going to give you a cheat sheet. This is the high probability trend trade checklist. This is each rule individually. And you'll notice on the checklist that strong top or bottom is listed because my first hour is the best of the best. My first hour is the highest probability. My first hour optimizes your chances of success. The strong top or bottom is not mandatory for a high probability trend trade, but it adds the warm fuzzies. And that's what it looks like. No triggers through a termination that reverses the market. Not no triggers through a fib. Not only the smalls made it through, but not the large. Absolutely no triggers through the area. And you have to remember, the small triggers are not one line. The small triggers are two lines. So that means that somebody's going to call me. That means that both lines of the small triggers, if they get through the area, it doesn't have the potential to be a strong bottom anymore. Do I have momentum? Odds favorable momentum. Is there separation between the small and large? This says on both charts. This is the best of the best way to take it. Overwhelming momentum up or down on both charts. Avoiding weakness. You know exactly what it looks like as you take those pictures. Do I have a termination condition? No triggers through the line, not broken, no clear path. That's what it looks like with the potential, but it's not broken until the small or large get through. Know the difference, because this look and this look have to be managed differently. Well, how do I define my entry? There it is, spelled out beautifully. Wait for the reversal bar, find your triggers, where are the areas? This is where your order goes. This is where the market shouldn't go. And then the second page is the same spreadsheet. Print it out, put it on your desktop, police yourself every time you take a trade. Use the words, speak the language out loud. Do I have odds favorable, large triggers on both charts? And if you say no, why on earth are you looking for the next rule, right? Rules aren't met. Never had anybody mark yes to each of these, all four of these, and do worse than 70%. Something to think about. And then finally, maybe not finally, but next, I'm going to give you the KISS plan, guys, the Keep It Simple Sunshine Plan. Everybody wants to be a day trader. Everybody wants to find all the trades. Everybody wants to always be in the market. Everybody wants to be the first one in, the last one out. Guys, that's not what creates success. Success, and the most successful day traders that I work with do the same darn boring thing every day. The same look every day, the same management every day. Why? Because it's been proven to win more than it loses. And the more you deviate, the less likely you are to win. So this KISS plan, once again, it's a stepping stone. Thank you for that, Nada. You can't see me, but I am standing up behind the pulpit right now. This KISS plan is a stepping stone in your learning journey. This KISS plan is designed to optimize your chances of success with a high probability trend trade. This is the absolute highest probability, best of the best. Oh my gosh, I can't wait for this trade to set up. I never want to miss a trade. And then through simulation, study, class feedback, and continuous practice, you'll craft a plan tailored to your personal goals based on your experience reading the indicators. Once you can identify momentum and path, and you can do it confidently and quickly, you'll begin to see more opportunities. You'll begin to see opportunities only based on momentum, based on ricochets off of that path. All of these different things are going to come to you once you learn to read your indicators. So focus on the best of the best first. And then once this becomes second nature, understand that more options will present themselves and you won't even realize you were looking for them. The simple plan for consistency: never fight the large chart. It's easy to say, right? Well, of course I'm not going to fight the trend. You told me not to, but you'll be tempted. I'm not going to fight those strong triggers. The large crowd creates that momentum. Why on earth would I try to go down when it's strong up? You're going to try to. Everybody does. Well, I'm not going to trade into one of those lines where the large chart reacts. I would never trade into a termination condition. Rule number 2 is not met. Ladies and gentlemen, that is the most broken rule out there. Go break the rules on Simulator. Go break them all and post them in the room, and let's talk about them. But if you can avoid fighting the large chart, you will find yourself 50 to 70% better than the average day trader. And probably 50 to 70% more profitable. You have to define your entry. Why? Because great entries create manageable trades. Great entries come from the point where the trend is most likely to continue, where that small crowd is most likely to fail. Great entries reduce risk. Great entries maximize profit potential. And your great entry is nothing more than a simple flowchart if-then. If I have a strong top or bottom, then I'll look for strong triggers. And if I have strong triggers on the large chart, I'll make sure there's no terminations. And if there are no terminations, I will enter at an area inside of favorable large triggers. And then your palms start gushing sweat. Then your stomach starts turning knots because now you've got something to lose. Now you're in a trade. Now you're like, oh my goodness, I need to get out quickly before they take my money, or I need to hold forever so I make all the money. As a brand new user, your highest chance of success is going to come from having a management plan that's every bit as simple and focused and if-then and pragmatic as your entries. So the KISS plan on management plan, it's based on 2 contracts, entering the market with 2 contracts. And it's designed to help you understand where stop placement should go. And it's designed to get you paid quickly, to get you out of the market before the emotions take over. So, your KISS plan is dependent on your ability to understand where the market is most likely to continue. And if you enter the market at a mid-band inside of favorable large triggers, then your stop is 4 to 5 ticks below those trigger lines where the market should not go. And once this is in play, there's nothing else to do. You're powerless. You're either going to get stopped out of this trade. 20 to 30% of the time you will. And you don't get to pick when those occur. You can't ever say, man, I really need a winner. Doesn't matter. Market doesn't care. It's either going to win or it's not. You'll never be in control of that. So you're either going to take that small loss where the market shouldn't go, or they're going to give you a reversal bar in the direction of the trend. And if they give you a reversal bar in the direction of the trend, then your new stop, the new point where the market should not go, is 2 ticks below that reversal bar. 2 ticks above that reversal bar if it's a short trade. And then once again, sit on your hands, pet the dog, high five yourself and keep them above your head. There's nothing to do. You're either going to get stopped out for an even smaller loss, or it's going to go to your first target. So what we've done so far is we have defined where the market should not go. Intelligent stop placement. Not chumming the waters. If that stop doesn't get hit, it's going to your first target. Your first target in the KISS plan is only $100. Only $100 away from your great entry. 8 ticks on the S&P. 10 ticks on crude oil. And that $100 goes into your account, and that contract comes off, and that exposure is gone, and your sweaty palms dry up, and the butterflies get out of your stomach, because you are now a success, and you're going to feel that confidence. They can't take that from you. And then you're going to move your stop to break even. Is break even the best stop? Probably not. And you'll craft a plan tailored to your personal goals based on your experience reading the indicators. But right now, as a brand new user learning to manage your trades, that break even stop with profits in the bank is designed to help you learn to trust the large chart, to believe that the only reason you ever took that entry was because of momentum and clear path, because you had room to your targets. So you're going to hold on for the second target. And you're like, oh, this is where I make $1 million, right? Nope. If you don't get stopped out break even, your second target in the KISS plan is $200 away from your phenomenal entry. Which means that one trade, 3 advantages, and probably 2 to 3 minutes of your life, you just made $300. Which means if that's the best you do every day, you're setting yourself up for a $75,000 year. If you take another trade, right, and it goes break even, and that's all you do, 1 to completion, 1 break even, $400 a day, pretty awesome. That's a 6-figure income. $400 a day, $200 per contract in a market that trades billions. And guys, the potential is just amazing. But learn the easy stuff first. Learn the basic stuff first. So in that file that I gave you guys at the very beginning of the day, and I'm going to give it again because I don't trust people to scroll to the top. There it is in the room. Everything you need to be successful with the software. You now have rules. You have rules that have been proven, that have been validated, verified, back-tested, traded live to win more than they lose. You have seen them broken down individually and then pieced together. You have a spreadsheet where you can go back and create recognition through repetition. You have all of this stuff to study. You've got a solid plan. You know what it looks like. You have a platform, 15 hours every week to drop your pictures, to ask for help, to say, you know what, Mark, I think I took this trade right, but I'm not sure. Here's what I saw. Give me a little feedback. Help me do it better. And my promise is that I will. You have everything that you need to be successful with the software, 100%. The only thing Nexgen can't provide you is the experience that you need to be comfortable. The only thing Nexgen can't provide you is the repetition to make these looks easy. That's on you. This is where you're going to start to get to work, guys. And I'm going to tell you right now that the people that focus on their pictures for a couple days before they focus on the results of their trades, those are the people that are finding the benefits and becoming chart readers and finding the success quicker, because everything that we do revolves around foundation. Everything that I teach in this room is it's village idiot trading. It's 101. It's the cliff notes. It's the most remedial approach to learning how to read your indicators. And then you get to compound from that foundation a little bit every day. There's a Japanese philosophy, Kaizen. And it's not about becoming successful straight out of the gates. It's about becoming 1% better every day for the rest of your life. And you'll be astounded at where you end up. So for you new users, or even for you experienced users coming back because success has eluded you, I blanket with very conservative rules. I talk about recognition of advantages. I hand you a solid plan that optimizes your chances of success as a new user as you learn to read your indicators, as you learn to trust your indicators. So for new users, all terminations are bad, and no momentum is bad, and areas beyond the trigger lines are bad. Blanket rules, because it increases the likelihood of success, and success creates confidence. These things aren't always bad, but until you have the experience to know when to use exceptions, it's just safer that way. And then just like anything, the more time you spend with the software, the more time you spend reading these indicators, the more times you ask for feedback on your chart reads, the more you're going to see, the more patterns you're going to recognize. This is going to open doors for you. This is going to create opportunity. But you've got to learn the process that yields the results first. Learn the trade that gives you the potential to be profitable as you learn to read the indicators. That's where the KISS plan comes in. If you keep it that basic, if you follow simple rules, if you're okay not looking for all the trades and only looking for the best trades, you can find an extraordinary level of success. And I've watched it repeatedly over the years, guys. I've been doing this for a long time. There are 0 mistakes you guys can make that I haven't made. And more importantly, there's no mistakes you can make that I haven't learned how to fix myself in my own trading. And I will share every bit of knowledge that I have with you if you just share your charts with me. You will get more comfortable the more simple you keep it. So question everything. That's for all of you. If you have a question, don't hold back. There are no stupid questions. The only stupid questions are the ones that aren't asked. It can be about trading. It can be about NinjaTrader. It can be about Discord. I know most of the answers, but there are times when I'm going to say, hey, go to tech. I'm just not sure. Go to tech. Jason can fix everything. The only thing Jason can't fix is what isn't broken. But give yourself a little grace. I love that phrase. Give yourself a little grace. You're new. It's okay to be. Ladies and gentlemen, that is my first hour. And I talk about keeping it simple as we get into the second hour because you're going to start to see trades that aren't high probability trend trades. You're going to see medium probability trades. You're going to see momentum based trades. Hell, you might even see what appear to be counter trend trades. Every picture that's posted in my room, my promise is that I will go back to momentum path and entry no matter what kind of trade it is. Because I want you new guys to know what it looks like when it's there and what it looks like when it isn't so that you can make the decision to trade or not. I ask respectfully, tell me what you see. Because if you tell me that you had momentum but you didn't, then we're going to go back to the lesson of momentum. And if you tell me that your path was clear but it wasn't, we're going to go back to the lesson of path. And if you told me that you entered at the area inside of triggers but you actually entered at the area beyond the triggers, even if you won the trade, I'm going to say, hey, once we get down here, there's just no telling where that thing's going to stop. And I'll give you an option for taking it. But I'm not going to look at your annotations and let you lie to yourself because I made a living writing what was supposed to happen instead of what actually happened. And it absolutely just retarded my forward progress. So tell me what you see. Tell me what it means to you. Tell me where you did it. And we're all going to get exactly where you want to be. So let's look at the live market real quick. This is crude oil. Does everybody see odds favorable momentum? All we're looking at is trigger lines, right? We're not worried about anything else on the chart but trigger lines. Smalls are below the large, large are wide, space between. Give me a Y, please, if you recognize this as the best trigger look you could ever have on a large chart to set you up looking for a termination condition. Awesome. So if I have strong triggers, then I have to see if I have a clear path. Well, price reached a divergence low. This is one of those areas that could stop the market. My small triggers broke through, but my large triggers are above. Does everybody remember? We call this a 50-50. 50% of my triggers are through, 50% are not. It has the potential to break, but it's not broken. It's not a clear path, which means I better rely on momentum in an entry area if I feel like I'm going to take a shot at this one. As it continues down, if I look over, this fib isn't in a trigger, but it's in between the triggers. It has the potential to break. Look at the range where the retracement could take place. That's pretty huge. So you're going to go through all of these things that we talk about. And for most of us, this is simply a no trade scenario. Not yet. Oops, that's the only workspace that I have open because I deleted my other one. So let's open up NASDAQ real quick. And for you guys that are new, NASDAQ's too fast for most people to trade. NASDAQ is faster than you can think in most cases. Even I can't trade the NASDAQ right off the open. It is crazy insane. But once you know your rules and you know what you're looking for, NASDAQ is actually extremely tradable, but probably not for new users. So as this one opens up, I'm going to take a break. I like to take a break every hour or so. I like to go stretch my legs. I just think it's important to do that. I think it's important to not stare at your screens nonstop for 5 hours, especially if your rules aren't met, because that's when we start to fabricate rules. That's when we start to break rules, because boredom creates problems. So here's the NASDAQ. The triggers are weak. 1, 2, 3 divergences in the same price range. A lot of red flags. Well, there it goes. And it came right back to that Fibonacci support with weak triggers, and we'll see what happens. NASDAQ is fast, ladies and gentlemen. Let's go back to crude oil. We'll see if they break that area. I'll be back in 5 minutes. When I come back, We're going to look at every chart that's been posted. We're going to answer every question that gets asked. So I'll see you guys in just a couple minutes. Second hour. I like you guys jumped on the train there. Still just the potential, right? Still hasn't broken. Look at all of this right at a key area. When we talk about people reacting at areas, when we talk about the market reacting at key areas, you'll see it if you just look for a little bit. Absolutely, Wayne. And guys, what Wayne just did, do the same thing. As we go into the chart reading, if you need them looked at a little quicker, maybe you have to go, always say it, I will. So let's see what we have. Wayne says, check it out, Mark. Odds favorable momentum and a clear path. Life is good. Pulls back to the mid-band, right inside. Wayne in just a little bit late. Would have entered lower, but the tail up, then going back down mid-band gave you pause. All right. So he had a reason for his entry. Beautiful entry. Profits right at trouble. And then out break even. No worries. Second lower divergence, rolled triggers. Didn't enter it this time. It looks like you did. You caught it on the way up when the triggers rolled, got back out at trouble, and then out break even. That's okay though. Guys, that is $400 in 20 minutes on a trade that essentially failed. Wayne, great job. Great management. Great management. And that's the gap. And what does Wayne mean when he says gap? He means that price has already reached Fibonacci support. It's hit the fib, and those large triggers are not coming along. Those large triggers are more than a full bar away. This is that look, especially from a weak top, where price loves to snap back and just close that gap right to those trigger lines. Nice analysis there, Wayne. Let me make sure that there weren't more as I scroll up to the top. I got your question. Was that it? Dude, great trading, great management. That's one of the things that I notice in you guys as you begin to mature as a chart reader is the ability to get something out of nothing, the ability to react to what your indicators are telling you, to be able to manage those trades, to find profits where other people are just holding and hoping. You've already been paid and jumped ship because things are changing. So Wayne, awesome. Hope everything's good at the doctor. I'm going to scroll up to the top and we're going to see some trades this morning. Miss Jen told me that there's some lessons in her charts. So we're going to click on all three and we'll start at the beginning. And guys, just a reminder, I scroll to the top, then to the bottom, then the top to the bottom. So if I ever miss a question, if I ever miss a chart, just go, hey, Mark, I think you missed one. Give me the time that I missed it, or even better, just repost it and go, hey, Mark, I think you missed this one. Could I get a little feedback? And I appreciate it. All right, so here we go. Jen says termination, no triggers through, so she's coming from a strong top. She says, check it out. I have odds favorable momentum. I love it. And she says there's no divergence, strong triggers. But oddly enough, Mark, my areas are not inside of triggers. So Jen's making a little bit of a judgment call here, saying, you know what? Rule number 3 is not met. But with this much momentum from a strong top, I'm going to get in right at the mid-band. I'm gonna throw a little caution to the wind here because I have these 1-to-1s right here. And these 1-to-1s have every trigger line below them. So they may stop the market. And she said, I'll just do tight stop. If it gets me, cool, not my money. But if it doesn't, I'll find a way to get paid. And you did it beautifully. You get paid on the way down. You don't let the fluctuations freak you out. And then when divergence prints on the 50-50, you take your exit before you lose anything. So Jen, awesome management. Awesome management on a medium probability trade. All right, odds favorable momentum, smalls through, large or not. Smalls through 1, large through. What does that mean? Can we just call this a 50-50? Smalls are above, large are not. It has the potential to break, but it's not broken. What does that mean? Smalls through 1, large through. Are you saying the large got above this one maybe? Oh, it doesn't matter. They work together. These are Siamese twins. Your large triggers can't be through an area unless both lines are through. That's it. Until both lines of the large triggers go through, the large are not through. Does that make sense? I'm going to keep it very black and white. You're welcome. So let's check it out. The first pullback to support inside of triggers had a divergence, which really isn't a great look, and not a termination condition, just divergence from a low. Guys, price creates this divergence line. Price doesn't reach this divergence line. So what you have is a failed 50-50. Amen. It's like being a little pregnant. Thought you were going to the doctor. Is that why you're going to the doctor? Congratulations, Wayne. Oh. Ba-dum-bum. So this isn't a termination. This is a loss of momentum at 60, 20, 25. It's a failed 50-50. So we have the momentum, we have the potential to break. You already have two divergences, and you say, you know what, I'll take it anyway. I'll take it from an area inside of triggers, not the highest, because, you know, I'm losing momentum. It's not broken. So you say, where's my least amount of risk? No worries, then. Jen, and correct me if I'm wrong. You said, if I'm going to take this trade that isn't perfect, what area inside of triggers gives me the absolute least amount of risk? I'll enter there. Instead of putting all this risk on the trade, I'll enter at the lowest amount of risk, easily to define, and then it starts to go up. You're in at 33, and it looks like you took a little bit of profit, and I don't know how you got stopped out. Oh, break even. You took 50 bucks and got stopped out break even? Yeah. No reason to get paid that early. I mean, 4 ticks isn't enough, right? 4 ticks is there's so much 4 tick fluctuation on a small chart. Could you imagine just putting your stop behind the reversal bar and enjoying the ride? But then you get back in, you're like, egads and little fishes, that wasn't the right stop. That wasn't where I wanted it. Okay, I'm going to make mistakes, but that's cool. And I'm going to get back in. Because nothing's changed, I should still be in this trade. And then 3 divergences print. And 3 divergences says, okay, the trend may end, path's not clear. And Jen says, you know what? Load up a bowl of hopium. We're smoking this morning. I know that the large chart doesn't have a clear path. I know it's not coming from a termination. I know that 3 divergences can stop the trend. But you know what? F that market. We're going to my target. And they got you, right? They paid you, Jen. They said, Jen, I want you to take this trade every time. Jen, I don't want you to ever miss this trade because more often than not, we're going to pull money out of your account and put it in yours, and put it in ours. So Jen, again, I get ecstatic when you guys break your rules and get lucky. You shattered your rules. You dropped them on the floor and then kicked them into the wall and ran them over in your sedan, put them in the garbage disposal, and set them on fire. And it worked out this time. And I know that that's not your plan, so thank you for posting, because you know that I know it's not your plan. But I'm glad you got paid. No. It's just sometimes we trade our guts instead of our rules. Everybody does it. Need the last 2 lines in Yoda voice? Broke rules, she did. Morgan. Great, now that's all I hear. So Jen, it's not lunacy, it's just a mistake. It's not lunacy, it's trading what you were reading more than your rules. And chart reading will do that. The better you get at chart reading, the more likely you are to form opinions about what the market's going to do. And that's where really sticking to your rules pays dividends. So I'm ecstatic you got paid. And there's so many advantages. And it doesn't mean that it's the wrong trade. I just think you started throwing a lot of stuff out the window, but let me celebrate, right? That's because I love to celebrate victories. Look at the momentum on the large chart. Look at the large chart. The large chart says we're going up strong, right? And the large chart's hard to stop. And Jen, I know that you know that. And that probably had a lot to do with why you were willing to sit through that and let that be your trade. Not mad at you. Great lessons. Great lessons. Pete says, Mark, I know how much you love Christmas. Let me show you 100 points worth of Christmas and then scroll down and find my trade. I love it. Yeah, that would be stressful, without a doubt. It can be easier. That's all right. That got your heart rate up. That qualifies as cardio. You don't have to work out today. Good job. All right, let's see what happened. Oil's going sideways, sitting on your hands. This is just that, hey, not my rules. I'm not going to do it. And I don't agree that the market's going sideways. I think it's definitively in a downtrend. It's below all the areas. The path is clear. But the small chart is showing that fight. And that's what Pete did. Is Pete said, man, Mark, I know it's down. And I know that it's pushing down. And I know that momentum's actually pretty good. But my small crowd shows me the change I can't see from the large crowd. And Pete's ability to recognize that his triggers are flat, that it's weaving in and out, that he can't really get something solid one way or the other, keeps him from hoping the market goes down. And it keeps him out of the loser. Great job, Pete. Great job. And then Wayne, we saw yours. Awesome. Gino, good to see you in here. Let's see what you're doing besides testing my eyeballs with your tiny little chart. Whoops. You've been doing that forever, my friend. I don't know, was this smart management or just lame trading? I don't know. You had momentum directly into a fib. So I would say that you kind of killed management in the beginning because you didn't give yourself a clear path. So you were just rocking momentum. That's all it was, is you said, you know what? I'm not going to take the trend trade because it's right into a termination. Tell me if I'm wrong. And you said, once price starts to break above, I'll give it a shot. And the problem is, price didn't actually break above. It tried to break above. And sure enough, that line created a bounce. You decided to stay in it. I don't know that that was the best management. Divergence off of a fib, termination, that could have gone south, right? But you held it anyway, and off it goes. You had no idea that fluctuation was going to happen. Are you in here, Gino? I see your picture. I see your smiling face. Guys, I'm going to give you a little insight. I'm just going to do it on one chart here. And I guess Gino's already gone fishing or golfing. So guys, do you remember the idea that fibs are where decisions are made? That fibs are where fights can happen. Everybody comfortable with that concept? I try to really beat that in. I want you to see what happens right around this fib. There's all those shenanigans and tomfoolery and buffoonery happening right there at that fib. So one of the cool things you can do, and Ron taught me this, is that if you just have to jump into that trade, if you're like, you know what, the momentum is great, I want to jump into this trade, by letting price, not triggers, nothing, but by letting a full price bar, the back of the bar, clear that fib, what you've done is you've taken price away from its reaction point. And now it has a little bit of easier path to go up with all that momentum. And Gino, I don't know if you're listening. Does that make sense, ladies and gentlemen? This is the brilliance of the chili dog trade. Get price away from that decision-making point, because look at the bounces it creates. And look what it did right here. With all that momentum, same level of momentum when it hit the fib, look at the drop. Is there any reason to believe that this would be any different? It's the exact same look. So let it get above, and if it doesn't get above, you don't have to take the trade. Great stuff, Gino. I hope you heard it. If not, he'll go check the video. We are recording everything. And then, Ron, let me get my chart small again. And I love this. So the large chart, and this just illustrates exactly what I just said. Ron's got odds favorable momentum and absolutely nothing in the way on that large chart. Does everybody see it? Momentum and path. This is your foundation. This is the core. This is the best of the best. Large chart says, Ron, I triple dog dare you to tell me we're not going lower with aggression. Ron says, that's cool, but even lines on a small chart can create bounces. Even lines on a small chart can jack up my good time. So just like we just talked about, Ron lets the back of the bar clear that little bouncy spot and just gets paid on the way down. And this is beautiful. And this is the chili dog trade. And the chili dog trade is nothing but momentum and path. That's all it is. And you guys will see it in this room. And nobody does it better than Ron, because Ron created it. Absolutely outstanding. And what a perfect, timely lesson. Nicely done. And he called it the rodeo trade. 8 seconds. 8 seconds to victory. Love that. All right, Pete. Pete, as my voice cracks, right? Termination. Small triggers come cranking down. Pete says, you know what? I'm not going long into a termination. That's the clinical definition of financial suicide. And with this great termination, with those triggers rolling, with all of this stuff starting to say down, let me get price beyond the bouncy point, and let's see if we can't ride that momentum down to the next fib. And that's exactly what you did. Pete, I don't know if you got your ears on. Great trade. Great patience. There was a time, Pete, where that was your long, maybe 2 or 3 times into that fib, hoping that it would break. And now you just said, to hell with it. Let me go with the flow. It's easier to get paid. I love it. Great job. Great job, dude. All right, Bob. Strong top. All right, so here comes our first lesson. This is one of the beauties when I know you guys are new. I missed one, Pete. Oh, there it is. Potential to break with 2 divergences. You get in, and it doesn't work. So you're letting something that happened at 2:14 a.m., at 4:51 a.m., at 5:30 a.m., and at 8 a.m. dictate what you're going to do at 9:30. I like this. This is a market that's trending down, absolutely. 50-50 trade with 1 divergence is problematic. 50-50 trade with 2 divergences is damn near financial just ruin. And then once the 3rd divergence happens, that was your push that took you back up to that key area. So just because you believe the market is in a downtrend that can't be stopped, decisions are made at fibs. And when you start to see that loss of momentum on a fib that isn't broken, your advantage is gone. That's it. You're starting to trade hope. Let it break. If it's going to break, it's going to break. I still say you're a great trader. But I feel like it's so clear when that advantage goes away. And then the next trade was the short off resistance, taking advantage of it. Yep. That one failed. Hell, you could have even taken it up to the termination. You could have. I've seen you take that one well. And then this is what I love. You didn't make the same mistake at the top that you made at the bottom. You just said, let me go with the chart. I like it. Great trading. Whoops. All right, Bob. Oh, Bob, I deleted your picture. Hold on. Let me get back to it. All right, so we're going to start with where the market is coming from. And Bob says, hey, check it out, Mark. I have a strong top. And then I have to tell Bob, respectfully, I don't agree. And let me show you why. Whoops, that's maybe a little bigger than it needed to go. Guys, this is strong tops and bottoms for the new user. This is strong tops and bottoms for you guys to be able to keep it insanely black and white, so you never make the mistake on a strong top or bottom. First, it has to be a termination condition. It always has to be a termination condition, and the triggers cannot get through. Remember, the small triggers are 2 lines, so 2 lines of the small triggers cannot break above. There's your termination condition. It's a strong top when it reverses, but the trigger lines tell the story. And yours, Bob, I believe, well, it's hard to tell there. Let me go back to your picture. It looks like the smalls got above resistance. And I know that we're nitpicking, right? We're being, Mark, it's 1 tick. Yeah, but for new users, let's keep it super black and white. It makes life a little bit easier. The same way this isn't a strong bottom, that's not going to be a strong top. Just keep it simple. But let's go into the whole thing. Odds favorable momentum, absolutely. 50-50 trade, absolutely. And then there wasn't a best entry here. Let's go back to your chart now. There wasn't quite a best entry here because rule number 3, and this is where I like to really use the verbiage, pull back to an area inside of triggers, and there just wasn't one. Do you see that? There just wasn't an area inside of triggers there. And if it had pulled up to the mid band all day long on that 50-50. And then we get down to the second 50-50. And divergence prints, which we know typically kills a 50-50. But you got in at 53. Your fib was at 65. So I want you to look at where your entry is. So Bob, you just jumped in, right? You said, oh crap, I missed it. I better jump into this trade. I'm not mad at you. Not mad at you for it. But let me give you a little, just a little knowledge. If you do jump in, guys, if you take that jump in trade, if you're like, okay, everything is screaming, I'm just going to hit sell now. That's cool. But whoops, let me go back. I'm bringing up a picture. That's why I'm flapping my gums. If you get a close on the wrong side of the triggers, and I'll drop this in the room for you as well. If the market gives you a reversal bar on that small chart on the wrong side of the triggers, this is a loss of momentum. So if you jumped in here, that is going to be your smallest loss that you'll probably take. Is that close. As long as it stays left of those triggers, Bob, hold on for dear life. Whether it's up or down. As long as it stays left of those triggers, it's going to keep going down. When it closes on the other side, when you get a reversal bar that closes above those triggers, or for a long trade below those triggers, that's where the retracements happen. So even though you pulled a little Hail Mary there, hoping that it would keep going down, that same bar that you entered on, that was your exit condition as well. Does that make sense? I don't tell you guys not to take trades, but sometimes I can tell you how to manage them a little more efficiently. And it's only the difference between what? 64 and 62. It's only 20 bucks, but 20 bucks adds up. I love the read. And now you're working on that patience because you're getting so good at the read that you're anticipating and you're excited about getting into the market. You're like, I know it's setting up. I can't wait for this trade. And that's where you just got to pump the brakes and go for those rules. Great job. Sorry, Steve. Class wasn't open at 8:59. Just kidding. Let me get up there. Sorry about that, bud. There it is. My bad. I do that sometimes, guys. It's never intentional. Never intentional. Man, we all do, Bob. That's the hardest part about day trading is doing absolutely nothing. All right, odds favorable. You had a clear path because the fib update. And there we go. See how Steve lets it get above the thing that could create a bounce? And because the only thing that has him in this trade is momentum, he's out quick. Quick 200 bucks, call it a day. And then he still has the great look, 50-50, no divergence, strong triggers, easy entry. And he rides that one for another 200. So, Bob, this is a good lesson. Steve, I'm going to pretend like I missed yours on purpose because this kind of reinforces what we just talked about. If you just jump in and get that reversal bar, everything's solid on the large chart, it may just turn into a trend trade. And Steve, you got paid twice in the same range because you understand that these trades are quick profits and these trades typically go to fibs. Beautiful trading, Steve. I'm glad we didn't miss that. That was awesome. All right, Nanda. Nanda, you're like, I wonder what it's like to be colorblind. Let me put a lot of gray in there. Do you not want me to look at these? I think we will. Because, okay, so there's a great lesson here. So Nanda said, I'm not sure where the gap down starts. I'm not sure where price may pull back to those large triggers, right? So Nanda, you're trying to get slick and go short, hoping that price returns to the long triggers. Am I right? So Nanda said, well, it's got to go down from this fib. And you're trading against trend and you're trading against momentum. And then, Nanda, you said, no, seriously, it's got to go down from this fib. And you're trading against trend, and you're trading against momentum. And then you said, well, it's got to be this fib. And you're trading against trend, and you're trading against momentum, right? So you just kept fighting everything, hoping that it goes down. So let's talk about how to do that better. Is this your first one? Your first one, triggers are up, smalls are above. Do you see it? Your second one, all your triggers are up, right? So the small chart is going to show change. Here's one of my favorite pictures. You're going to love this. And Nanda, I've done this 100 times, so I know exactly how to combat it. There is the it might hold versus the it's held. So I'm not going to go through all of this, but there's your first entry, your second entry, your third entry. I hope this stuff holds, but your small chart keeps saying up. Does that make sense? And I want you to see this. Once those triggers roll, now your small chart says down. Now the change is happening. Now you're starting to see that little transition that you're hoping for. I think it could, it might, there's the potential, I hope, Let me let the small chart turn, and then I have a better chance of capitalizing. So Pete gave you an awesome lesson there. And even if you don't wait for the large triggers to roll, as long as those small triggers are above the large triggers, the likelihood of it just dropping out of the sky and going down is pretty minimal. Does that make sense? And I love it. It's fun to be first, Nanda. It's fun to be the one in against the trend. But when that background's green and it's odds favorable up, you really need some advantages over here. And you finally got lucky on the third one, I think. Oh, that was Steve. And look at that. The one that worked, it was from the highest point, but you were still fighting. Everything on every chart set up. Your large triggers were above support. You had odds favorable momentum. So often people are so hell-bent on being the first one in that they forget that going with the trend is pretty easy. I like the pictures, Nanda. I appreciate it. But I'll tell you, it's when I learned about the gap theory, and I know that's what you're trying to trade here. When I learned about the gap theory, I did everything that you just did. And I would take a trade. So I would take a trend trade, and maybe the trend trade didn't work. And I'd say, well, the large triggers are still down, so I'll go short at these 1-to-1s. And I might take 2 shots at it because I think that it should still go down. I'm like, well, now the gap theory's in play. I'll just go short here. And then I'm like, oh my gosh, I just got run over again. And Nanda, I've given away $700, $800, $900 trying to short a market that doesn't say go short. So there's a way to do it, and there's a way to do it a little easier. And it's let the small chart lead the way. Let the small chart tell you. And just for grins, I want to see when this resistance was hit and the large triggers were still down, there still wasn't a good opportunity. It's hard to go counter trend. It really is. And I don't know if there's anything I can tell you on how to successfully take the gap theory trade. Let me look at your chart again and see if I see anything. I mean, you had 3 divergences. That might have been a good shot. 3 divergences. But you're still fighting the momentum. So I think it's just important that you know that as long as you're trading against strong triggers, the likelihood of success goes down exponentially. I'm not saying don't. I won't tell you how to trade. But one thing about counter trend, maybe one and done. A lot of people might be one and done on that. If it doesn't go down, okay, awesome. They failed for the same reason that the third one was more likely to fail than win. The third one just happened to go, Nanda. This one, Collie? Yep. This was a lesson John Novak built for me a long time ago, and I rebuilt it. Because this price, hoping resistance holds, once everything rolls, it's almost the exact same price. And it's crazy how often that happens. And it's what you don't do in this range. Awesome. Yeah, I will share everything that I share. Nanda, I liked the thought behind it. I really do. I like the thought behind the trade. I like the idea of using gap theory. And I like even more that you understand it enough to get out when price returns to the large trigger. So we didn't see this one yet. When it does finally work, you close the gap. So hold on, let's see something real quick. Even this one might not have been Because you got in on the other side of the triggers. Maybe just a little management. If you do get in, maybe don't hold it forever. So the idea here on the first one I like, right? It's starting to go down. It's on the other side of the triggers. But when support holds, divergence prints off support. Maybe take an exit. So maybe a little management. I think you took a good shot on the first one. I really do. I think you took a good shot on the first one. I think it could have been managed better. Does that make sense? I had to go back and look at it a little bit. I think that's solid there on the correct side of the triggers. That one, even that one's on the correct side, but be willing to manage. Maybe we're just giving back too much, potentially. I like it. I like where your head's at, Nanda. I really do. Especially in a market that's been trending down. Maybe just a little bit of management. And then this one's beautiful. The exit's awesome. I wanted to go back and point that out. That when it did work, the exit is perfect. Exactly where it should be. Nicely done. I love it. There's lessons in everything. You're welcome. Thanks for posting. And thanks for posting stuff a little outside of the norm. That's pretty cool. All right, Harry. Entry at 72.96. Right at the area inside of favorable large triggers with momentum and potential to break. Day 4, Harry. Am I right? So one thing, Harry, that I would do. I love everything about this. Please do not even think for a second that I don't. I think this for new users pays dividends. I think if you take the time to type out strong triggers, but instead of rules 1, 2, 3 met, rule number 2 actually isn't met. This is what we call a 50-50. Potential to break, but not broken. And then over here, it's beautiful. Pull back to area inside of triggers, right? Using the language. I think if you take the time to annotate with the words of the language, what happens is it does a couple things. One, you're reinforcing the looks and what they mean to you. But this, Harry, is going to be the most important thing. And there's nothing worse than me picking apart a beautiful chart, right? When I say to myself, this is a 50-50 and not a clear path, I take off my go for broke hat and put on my may need to manage hat. And that's all it is it's just the acknowledgement that this isn't perfect. So if something changes over here, maybe I adjust things. Does that make sense? But that's why I do it. In the beginning, until you can say these things in your head, type them out on the chart, because when you go back and study them, it really creates awesome lessons. And then one more thing, Harry. I'm going to go to my charts real quick. So I notice that you don't have stops and targets in place. You're in there, but you're 100% exposed and you don't have targets anywhere. And maybe you're just practicing entries. Now you have them. Okay, cool. Then I won't even go after it. Because look at your awesome entry. Once you got that reversal bar, you had 3 ticks of risk. You had 3 ticks of risk on that great entry. I love seeing that. And it just kind of verifies that if you guys keep it simple, you're going to find these trades sooner than later. Beautiful. Beautiful, beautiful. And if this were the KISS plan, you were already $100 in the bank and break even. That's money. Beautiful trading, Harry. Careful. You're going to make me think I'm good at teaching. 4 days in. Need to see that green check mark next to your name. All right, Jeffrey Dean. Jeffrey Dean says, man, like Nanda, I want to be the first one in. I want to go the other direction. So let me go through this again. So the large chart says downtrend. The large chart has smalls below large. The large chart has the potential to break support. The small chart has synthetics down. Large not above support. Why are you going long, Jeffrey? Let me read. Saw price coming down to support and large triggers. Set a limit, seeing a clear path to the mid band on the large chart. Kept your eye on the mid band on the small chart in case of reversal. Got out. Got out at about 71.82. Had to take a call. All right. So, why do you have a large chart? Would be my question. Nothing on the large chart suggests that it's time for a short, right? Not yet. You're not coming from a termination. It's got the potential to break. It's a downtrend. And you're just going to jump in on the way down because you see a blue line, right? It's hard, but let me go back and let's celebrate too. The same thing we just talked about, right, Jeffrey? Your large triggers might be showing a little bit of change that you can't see. This would be what we call a low probability trade, because it is more likely to fail than it is to win. And crude oil may not be the best example today, but it's more likely to fail than win, because that was the look right there. And obviously things have to roll. So I'm obligated. Again, I'm glad that you won. I think it's awesome. That one's going to lose really more than it wins. But the fact that you waited for this gave you a fighting chance. The fact that you waited for those to roll gave you a fighting chance at going counter trend. So I'm going to point out the good and the bad. And I'm glad you won. Nicely done, Jeffrey. That's your trade. You like to go counter trend. You're not a go with the flow kind of guy. Who was this? This was... I clicked and then I forgot to look. This is Cav. All right, Cav. 50-50 trade. Right on. So why do you look for an entry? Let's say that. Why do you look for an entry? What are your rules for entries? What makes an entry better? Because the entry is the third part of the equation. The entry is what you look for when you have an advantage. And the small chart doesn't produce advantages. It only produces entries. Something to think about. So 50-50 trade from a great top didn't work. Huge stop. Oh my gosh, huge stop. Cav, are you in here? All right, so I'm going to share something with you, and you've probably seen it, and maybe you haven't. On the NASDAQ, if those small triggers are less than a full bar away as you get to your area for entry, those small triggers, because it's such a big chart, very often act as support or resistance, and that's exactly what they did to you here. Price never gets below them, and they act as support. And one way to avoid this loser, one is don't fight the small triggers. Two is when you get the reversal bar, be willing to reduce risk. Because when the NASDAQ goes 50-50 with divergence, it goes fast, and it did, and it got you quick. But then nice turnaround. When the 50-50 fails and everything's up and you have the best strength ever, you get in on a little momentum trade off of the fib and take it up to the next fib. So nice recovery. I think that your loss was a lot bigger than it needed to be here. Does that make sense? I think you were convinced that this market had to go down for you because of the strong top. But those trigger lines, I hate fighting those trigger lines. I probably would have entered right here, and even then it would have still gotten me. Great recovery. Nice turnaround on that one. I like it. Boaz. I never know if I'm saying that right. Odds favorable. Clear path. Perfect entry. Didn't work. Boaz, there's times where people post these and they ask me, hey Mark, what did I do wrong? Hey Mark, what was the mistake on this one? What didn't I do correctly? Guys, I want you to see this. The advantage of momentum is 100%. The clear path is 100%. The only thing I might say is you were in on the wrong side of the triggers, a tick or two above, and then the bottom of the triggers were at 46.75. You could have been out right here instead of right here. So you had every advantage. You had the perfect entry. You had everything correct. And this is a trade that typically wins 70 to 80% of the time. So congratulations, you found one of the 20 to 30%. But the only thing that you omitted from the equation, once you're 4 to 5 ticks below those triggers, it's game over. Your advantage is gone. So maybe no reason to leave that much risk on a trade. And I know it's 12 ticks, right? And you're like, but Mark, my ATM strategy says 12 ticks. Here's the beauty of the methodology. Your initial stop is right here because of where the ATM strategy is. All you have to do is click that line and put it where the market shouldn't go. And that is approximately a 6-tick difference, which is, what is that, $75 difference in the loser? That's kind of nice. It's nice to not have to give that much back. It's a great trade. Everything about it is spot on perfect. It just didn't work, and you would have had the opportunity to manage for a little smaller loss with that very simple KISS plan. Great trade. Good looking trade, Buzz. You're welcome. Mid-band, large triggers a full bar away and still up. So Jen, you said I'm not just going to jump in. Let me get above the large triggers and above the fib. I'll get out at the, I'll take a tick. And then I'll get out on the reversal bar. Covered commissions on the first one. Yeah, you covered commissions on the first one. That's a one contract trade. But Nanda, maybe this is a good one, right? I'm thinking it's going to be. Let me get to the other side. I like it. Jen, that one's never been in your plan. Just saying. And the large triggers really weren't a full bar away. You had a good 5 or 6 ticks into it. All right, Cav. It wasn't. They weren't a full bar away. All right, got in on the pullback to the large triggers, stop above the large triggers, quick profits because he's trading into a termination condition. Sometimes it works with all that momentum. Everything says down. On NASDAQ, these pink 1-to-1s are a termination, 100%. These pink 1-to-1s can stop the market cold. Great entries create manageable trades. Nice, Cav. One more. Into a termination condition. Works out again. It's hard to argue results. I always go back to, and this is just me. Why is rule number 2 a thing? because they hold more often than they break, at least for a moment. And I want you to see what Cav did. Cav said, look, Mark, there is so much stinking momentum to the upside. And I know that the large chart is hard to stop. With that much momentum into the fib, there's a good chance they're going to retest it. This is a pattern that I've recognized, which means that I'm not going to get greedy past the fib. So once you know what you're up against, it'll help you manage. And then Ron took a trend trade. Oh my gosh. Class is over, guys. If your feet are getting cold, it's because hell just froze over. Ron, you just took the perfect 50-50 trade. Odds favorable momentum, potential to break, no divergence and strong triggers, pulls back to the area inside of favorable large triggers, quick profits on the way down. Man, I never thought I would do this. Let me copy that and let me go to the client's trades. I never thought in a million years. I love it though. And Ron's perfect 50-50 short. Ron will be the first one to tell you that he takes that awesome chili dog trade because he learned this one first. Frame that one. Oh, it's going up on my wall. It's my next tattoo, Ron. I'm going to go get this one tattooed on me. But Ron learned this trade because he learned the high probability trend trade first. Because he understands the likely scenario, not the guaranteed scenario. And he knows where it comes from. Awesome. Good stuff. What's the live market doing? There was that 50-50 he took. It's still working its way down. Awesome. So guys, I'm going to leave you with the market for a minute. I'm going to go stretch my legs a second time. When I come back, we're going to talk about whatever you want to talk about. We've made it through every picture. I think you guys have proven that once you can read charts, you can find opportunities. Harry's proven that 4 days in, you can find these opportunities, right? Pete, you took the trend trade short as well. Nice. Why wouldn't you, right? Why wouldn't you take that one at 10.55? Oh, no, I didn't. Thanks, Ron. Back of the price clears trouble. Odds favorable momentum. Odds favorable momentum galore. Nothing in the way. Galore is the weirdest word ever if you just say it on its own. Bingo, bango. Right out at trouble, right out at trouble. Momentum and path. Momentum and path. I love it. That's true. Not with James Bond. Awesome. Guys, I'll be back in 5 minutes. Go stretch your legs. Last hour or last 30 minutes. Let's take a look and see what's going on. Jen's getting us going again. And odds favorable momentum. Potential to break. We already saw this one, Miss Jen. That's the one where you got in a little outside because you had those one-to-ones to back you up and low risk. That's okay. You're not the first girl that just wanted to talk with me. Reset, let's see what you did. I bet I know what it is. All right, Kurt says, odds favorable momentum. Yep. 50-50. Absolutely. Divergence printed. Rules broken. No trade. I love it. And sure enough, it looks like it kept you out of trouble. Good job, Kurt. And not a strong bottom. Reversal in no man's land. It's frustrating. Why is it frustrating? Your rules keep you out of losers more often than not? Okay. It doesn't sound so frustrating when you say it like that, does it? My rules keep me out of losers more often than they don't. I know. I've had to work through all of it. So, okay, so let's talk about this 50-50, Kurt. Let's talk about something that you can start looking for. You're a great chart reader. And you're getting a little bit beyond the basics. Hold on. You know I have a picture, right? I always have a picture. So, Kurt, this is a good one on NASDAQ, too. So something happens that messes up your ability to take the trade because of your rules, right? 3 divergences, 2 divergences, divergence on a 50-50. So I want you to see this. You're thinking, man, I can't take this trade. 3 divergences, don't get in right here. 3 divergences may terminate the trend. The small triggers are down. You're like, I don't know what's going to happen. And that's kind of what happens when you get a couple divergences on a 50-50, right? So look at what happens. The large triggers stay up. The synthetics stay up. And the small triggers roll in the direction of the trade. This little snap back to the small right at an area, that's kind of a continuation entry. That gives you the opportunity to maybe take advantage. Market never breaks the large triggers. You just knew that it could push lower. And then you find that continuation, and it's almost the same price as the other one. And then the same thing is here. 2 divergences, maybe it's a 50-50. It goes down, you're like, ugh. And then when everything rolls and continues with the trend because the large chart says, that's your look. So go study it a little bit. Let's see if, and I don't know if it happened. I'm not sure if it happened. This is on all charts. Let me see. I've got NASDAQ. You've got micro NASDAQ. They're two different markets. So that was right around 1030. Man, this market moves a lot, doesn't it? So we were looking right about here. Let's go back and take a look. And remember, this is the large NASDAQ. This isn't the small NASDAQ. Different market, maybe different fibs, maybe different entries. This market screams. That must have been news. I hope that was news. That's crazy. Almost there. All right, so here it was. It really didn't give you that one. Oh, that was yesterday? Well, how would I know that? That's okay. Let's go to yesterday, 10:30. Let's just, I'm just curious. So that was it. Looks like your rules kept you out of a loser based on the large chart. I think this was it right here, wasn't it? It was somewhere over here. 1037. Nope. It was this one. 1034-ish. I don't know. It's hard to match the two up. Let me see. Let me check time stamps one more time. So it was around 1027. Okay, so it was this one. Let's put a circle on it. This is where you were thinking of taking it. 1034, 36, 37. Okay, I may have gone back one day too many. No. Did I go back one day too many on this one? There it is. Sorry, that took me a second. There's so much movement in the NASDAQ. So, Kurt, let's just kind of reiterate. Is it that frustrating to not be able to take that trade? Look what happened. I do this sometimes. And then it comes down 50-50 with divergence. Once again, your rules keep you safe. I mean, come on. 50-50 with divergence. Your rules keep you safe. I don't know, Kurt. How many trades do you need a day to hit your goals? What if you held out for the 3 best trades? And I think that's trading. That's trading. And man, I have days, Kurt, where I'm mad at the market for not giving me what I want. And then there's days where I am so thankful that I have rules designed to keep me out of some trouble. All right, Miss Jen. Odds favorable, 50-50. You take the reversal bar. I'm not sure you needed to. Right? I'm not sure you needed it on this one, Jen. Strong top, odds favorable, potential to break, no divergence, perfect low risk entry. That's one of those ones. It wasn't inside, fair enough. So you get in on confirmation. You get out. And that confirmation tightens up, break even gets a little close. And then Kurt, look at that. The triggers roll, pulls right back. Oh man, that's your... Oh man, I missed this entry. There's my second entry. Kurt, keep eyes on that. Start studying that one. Jen, it's a great trade. I think that on that one, your entry was so much lower than where the market shouldn't have gone. You had to make a choice. You either had to leave risk on the trade where the market shouldn't go, or you had to hope that they didn't do that. Does that make sense? If you're in up here, break even makes perfect sense. Putting your stop right on the fib, right inside of the triggers. Because isn't that just a 50-50 trade look too? So that's kind of that next level, Jen. I mean, you got paid, and that's cool, right? It didn't give you the perfect entry, so you waited for confirmation, and there's a cost associated. And the cost on this one was that break even puts you right in the danger zone. Your stops are not a few above the large theme. Yeah, well, you're not consistent today. Forgive me. You're not consistent today. This one you wouldn't get in at the mid-band because it was 2 ticks above the triggers. The other one you got into mid-band and it was 5 ticks above the triggers. So the more you vary your rules, this is a good lesson. The more you change your rules as the day goes on. Jen, you know your rules like a surgeon knows anatomy. And anytime you break your rules, anytime you deviate from your rules, you are more likely to arbitrarily move stops. You're more likely to believe that that trade's not going to work. And you start leaning on hope. I hope it still goes down. I hope it doesn't get my stop. But when you're following that plan, Jen, that you spent so much time studying, perfecting, when you get in at the area inside of triggers and that trade is perfect, you almost always hold for your targets. You almost always show me an exit at this fib instead of getting stopped out at this one. Does that make sense? And that's human nature. And that's one of the things why I say great entries create manageable trades. So let's see if we can come up with something that you can look at the same way that we did for Kurt on the entry. And I'm stealing this from Wayne. So Wayne, if you're watching this video after the fact, we're using your lesson. So Jen, here's your setup, right? Everything in your arsenal says that mid-band a couple ticks above the trigger is super likely to hold, right? 50-50, strong top, everything's down, and that's the area for a bounce. And I know that's what you were thinking. And your thought process is, okay, I'm not going to jump in at it. I'm going to follow my rules. I'm trying to do good things here. One of the things, and there's, and it's Janesh, the guy that teaches the AL class. He loves the half bar entry. As it goes up and hits the area, he'll put a stop order, not at the reversal bar, but rather at the base of the bar before it goes into the area. So Jen, maybe that's a way to cut your confirmation in half, to reduce your risk, to increase your profit potential, because the trade is the right trade. And Wayne does something like that, where once it hits that area, he'll put a limit order just a little bit below it. He's like, I know that I want it to hold. It may not. If it does on the way down, I've got virtually no risk. I'm cool. So maybe that'll help. Buzz, every chart is a momentum chart, my friend. Every chart is a momentum chart. This chart has momentum, right? This chart has momentum. Momentum isn't a chart. Momentum is small separated from the large. Does that make sense? Because you've got to understand that first. There's no magic charts for momentum trades. Momentum is defined by the trigger lines. It's important that you understand that in order to understand the momentum trade. How do we use the momentum to capitalize on a momentum trade? I'm so glad you asked. Well, first, You let the market come from a strong top or bottom. You let the market reach a Fibonacci area. That Fibonacci area stops the market cold before any of the triggers get through that area. That's rule number one for the momentum trade. It has nothing to do with momentum. It has everything to do with the understanding of termination conditions. The second rule is making sure that that bounce off the area hasn't reached a termination condition. So once again, the momentum trade has nothing to do with the momentum until you get to rule number 3. Rule number 3 is taking the momentum on the small chart after a termination, after everything rolls. Those are HVAs. Hold on. And with that momentum off of the termination condition, taking a little snap back to a fib and hoping the momentum carries you. Does that make sense, Bose? So that's identifying momentum after a termination. There's your first shot. And then the other one is when you have momentum on both charts, 100%. Taking the snap back to the fib. So there really aren't charts that are momentum charts, but rather there is rules to help you capitalize for the momentum. Awesome. There's the rules. They're in the trading guide. There's some good pictures. And then even if you go back, here's kind of an example of it. Right there. So the large chart has the potential to break. And then, Bose, this is the important one. Price gets through the fib. Small triggers gets through the fib that we're hoping breaks with all that momentum. And then you get a little tap in price. Pow, right off of that fib. That's your momentum style entry. That's how you use momentum on both charts. And all it is you're hoping that the momentum breaks the fib. 2 down bars, you're out of this trade. So there's a good example of it right there. And there it is again. You have momentum. You're hoping it breaks. Little breakthrough, snap back right to it right at the small triggers. It does it again right here on the 1-to-1s. But that's your look. Ba-boom, ba-boom. If it's mid-move, you need momentum on both charts. If it is from a top or bottom, you're really only looking for the momentum off the small chart. Good question. I hope that helped. And then if you want to go back and take pictures, practice this, simulate it, drop them in the room. We'll talk about it all day long and see if I can be helpful. Joel, strong top, 50-50. Beautiful. Oh, you got head faked. You got head faked, Joel. You were waiting for the mid band and it started to go down and you said, oh crap, I better get in. But that's okay because you knew where your stop needed to be. So you had to suffer a little bit and you did it beautifully all the way down to the fib. Just a little early. Nice. Hey, Cav, take care. Great trading today, man. Great chart reading today. Joel, great trade. An awesome hold. And Jen, that's your hold. That's what I see you do all the time. Just wanted to point out. That's your norm. Back at the price clears trouble. Everything says down, in. It didn't quite hit it. You got out on the way up, and then it got to the second one. So, once again, Jen, that's not your stop. That's not where you put your stop on this trade. You know that. Your target is either 10 ticks or the fib. Every time, consistent. You're hyper-focused on the tiny little movements on the small chart right now. Was there any reason to get out of that trade there? 2 ticks below your entry. Of course not. You know the answer. It's rhetorical. So I'm going to make a suggestion, and this is not a trading advice or anything like that. What I'm going to say, Jen, is maybe take a day out of your life, or maybe market replay tonight. Crack open a non-alcoholic beer, pour some grape juice, and your only focus, Jen, your entries are beautiful. You know where they come from. Take a day of market replay and just let these trades run out. Just let them either hit targets or stops, and do it on simulator so there's no fear, and kind of redefine your trust in your amazing plan, because your plan is amazing. And typically you're in here and out here and you're cranking. Yeah, but decaf is awesome, Kurt, if you have a heart murmur, right? Some people don't need caffeine. Some people don't need alcohol. I had a lot of friends that don't need alcohol. So, Jen, that's one thing that I do, and that's why I said non-alcoholic, Jen, because I listen to you guys. One thing I'll do when I get jumpy, and I get jumpy too, guys. There's times where I think more about the money than the process, and I think everybody has days like that. I'll go back to simulator. I'll go back to market replay, and I'll put my stops and targets where they belong, and then I'll just let it run and see how many times it goes to my targets instead of my emotional stops. So again, I'm not telling you how to trade. Not telling you how to trade, but I found for a lot of people, even myself, that's pretty helpful. When you know you're getting a little jumpy. I know you do. And I know your plan well enough to know when you deviate, and I feel obligated to point it out. Tracy said, I took that trade. And we're going to that darn fib. Nice trade, Tracy. Perfect 50-50 trend trade? Absolutely no reason. Move stop to just above the triggers. Put second buy 3 ticks above the first trigger. Did it hit your stop or did it hit your target, Tracy? I think it hit your target, didn't it? Beautiful trade. Great hold. And I love that you're not giving it back. Why on earth wouldn't you collect that $200? Had a great top, clear back around 4, and never had a great bottom since. I love it. Trading with the trend. Oh, there's the entry. My bad. So there's the entry. Quick profits, 50-50 at trouble. Let the second one run. Hit the trouble area, go break even. Force it to take you out or hit your target. Beautiful trading, Tracy. I like it. You're so quiet in this room, but every picture you post is an awesome lesson. All right, Pete, not a strong top. I disagree. That is the most beautiful strong top ever. That is no triggers through. Double termination, full reversal, odds favorable. And Pete says, you know what? With all of this momentum, no, they didn't. So let's go back and revisit this lesson. All right, so Pete, this is the hood of your car. This is the trunk of your car. This is the brick wall. Did your car get through that brick wall? I suck at analogies, but I just came up with this one. You did not get through that brick wall. Remember that it's 2 triggers that make the small triggers. Yeah, so if one line gets through, who cares? I mean, they're moving out. Thanks, Tracy. Make the whole car get through. Good stuff. That worked, didn't it? Somebody call my wife and tell her that every now and then I have a good analogy. And then I love this. All the momentum, and you get in finally, right? That finally makes sense? I guess I'll have to use that again. And Pete says, check it out. I'm going to get paid first shot out at trouble. I'll wait and see what trouble does. Boaz, there's your momentum trade. Breakthrough, snap back. Pete gets in a little bit late. I'll get in after trouble. I'll get out just before trouble. And then I'll get in after trouble, but it didn't work out, so I exited. And I'll take the medium probability trend trade. I'll take half off, and I'll write it down to the fib. And this is beautiful. Pete, I love everything about everything you did from start to finish. With all the momentum, in, out, let it break, in, out, let it break, in, recognize it isn't working, so you take the trend trade and write it down. I mean, oh my gosh, this is a day's worth of profits in 20 minutes. Simply outstanding. Thanks for sharing that one, Pete. Morgan. So guys, this would be a strong top if they hit reverse and go the other way. That's awesome. Steve Diego, I finally didn't miss you here. Odds favorable. Hell, clear path. Tough to hold with fluctuations up and down, but 13.2 momentum said keep short. And it went down, both contracts off. That's the small chart, right? If you focus on it, it'll go crazy. It does, Morgan. But when I get them, here, post that picture in there again. I'll show you what I see. So what I see is, did you see how it was blank for a second, like just a gray background? Typically it stays like that until I click on it. So when you guys post without the screencast link, I typically can't see what it is until I click on it. That's why I click on it and bring it over. So what I'll do is I'll click on it and it'll show it to me over here. And then I'll open it in the browser. That's one of the reasons why I love it when you guys use the screencast links in the room. Because when I go to Wayne's, whoops, and I just click on it, instant, straight to browser. But it's not that big of a deal. Wayne, what are the average triggers? That would be my first question. What's the average trigger? The large triggers, the slow triggers didn't break? You'll call this a strong bottom? That's okay. You're allowed to. You're allowed to. When I have this look, Wayne, me personally, I have to see 3 divergences on the small chart. Why? Because I don't want the triggers getting through. I'm not going to tell you you're wrong, but I disagree with the very basic premise about that's a weak bottom, always. That's a weak top. For me, always. That's a weak top, always. That's a weak bottom, always. It doesn't mean it can't reverse. It just means that those 50-50 trades maybe are a little less likely to work, and that's what we use it for in the new users. We use it as remember, this classroom is designed for the best of the best, Wayne. For the highest probability, for the most optimal chance of success. It doesn't mean that you can't look at your picture and say, you know what? The large triggers are freaking 3 days above it, and the small triggers push through a little bit. I love this look, and I'm totally willing to take a 50-50 the other direction because I've seen this enough to know that sometimes triggers push through. Does that make sense? But if you're brand new Isn't it easier to just say no triggers through? To not have to think about overrun, to not wonder if it was overrun? So as you guys get better, you challenge me on things, and I love that. But I always have to remind you that I always go back to the basic highest probability look to teach this class. And then when you guys post your amazing chart reads, Wayne, I don't disagree. But even from the rules, when we talk about that good top or bottom, it's very clear, no trigger lines through. So there is a best of the best, 100%. And it doesn't mean that you're wrong. It just means that you have a different outlook based on your ability to read the triggers, which is everything that I've ever hoped for you guys. Great question. And there we go. Weak bottom with everything screaming up. There's that momentum. Easy chili dog trade. So it could be overrun. It could totally be overrun. And very often when it is overrun, you'll start to see these divergences printing on that faster chart, letting you know, hey, they just had so much freaking momentum, they overshot the area a little bit. I hope that made sense. I try to never be confrontational. I understand that everybody sees things different, right? Wayne and I walk into a bar. Two beautiful women walk up and we look at two completely different women because he's into blondes and I'm into brunettes, you know, and that's okay. Doesn't make it wrong. We still high five. I saw that, Marty. Thank you for the play-by-play. Show me your epic trades. Joel, odds favorable, clear path. When it doesn't quite get to your area inside of triggers, you say, ha, I'll catch it on the way up. She's a brunette. She can be my brunette, Ron. Great trade. And here's a good example. So Joel, can we play hypothetic? If from where you entered, it came back down, do you understand that your stop still goes below the triggers? That's the only thing that I asked you guys, is if you don't enter at the area and you take a confirmation bar, there's still the likelihood that it pushes down to that area. You just have to keep your stop in the right spot. Hey, Tyree's in the room. Long time no see. Good to see you, man. Great trade, dude. Great trade. There's more risk when you get in on the fluctuation. That's all I want you to know. Doesn't mean it's bad. Doesn't mean it's bad or wrong, right? It just means that you know where the market shouldn't go. You accepted the risk. That's all. And that's pretty cool that you guys can do that. That's pretty amazing that you guys can read your indicators and make good choices. That's all I've ever hoped for any of you guys. Learn to read the charts and find your way, find your groove. Dance to your drummer. Doesn't have to be mine. So guys, that's it for me. That's the end of class. Had a blast. Thank you for letting me be a part of this. I will see you guys tomorrow morning and we'll do it again. And Wayne, you were at the doctor, but we used your lesson about getting in on the way down instead of on the way up. So I just wanted you to know that the lessons that you bring are in fact impactful. And I've stolen them a little bit to help people get into the market. And I will do that. I will liberate. I'm sorry, Marty's. Class is over. Go show that to someone else. Not really. For you guys that don't know. I'd even say it on their way. And I'm like, Wayne, if you're watching this, beautiful, Marty. Everything up. Not odds favorable, weak triggers. Not odds favorable, weak triggers, but it is strong trending. Beautiful entry, beautiful exit. That's not a bad day, 1400. That's 30 days in with the software. Didn't even bother to learn the high probability trend trade. I taught him this trade first off, and you were crushing it. Nicely job. Nicely job. That's not actually a word. So I'm going to get you guys, I'm going to drop today's YouTube link in here for you. And then I'm going to go away. I've got to draw on people today. So have an awesome afternoon. I'll see you guys in the morning. If you need anything, be sure to reach out. Remember, if you refer a friend, 20% referral fee is what Nexgen's giving away right now, which means that most of you, if they get a lifetime, guys, that's like $1,600-1,700 in your wallet. Bring a friend in. Get that referral.